Look, I'm going to level with you right now. It's mid-morning on January 13th, 2026, and I just watched something I've been tracking for 12 years finally happen. Silver broke through its all-time high, but if you turned on CNBC this morning, you probably heard the same recycled story about Federal Reserve drama, Trump versus Powell, the usual political theater. And sure, they'll mention silver in passing, call it an inflation hedge, maybe throw in the word fear trade and move on to the next segment. They're wrong. Completely wrong. I'm a private commodities analyst. I've been stacking physical silver for over a decade, and I built this channel because I got tired of waiting 12 hours for the mainstream media to report what I could see happening in real time on my Bloomberg terminal. And lately, with all these AI avatar channels pumping out fake hype about the silver rally, I wanted to cut through the noise and give you the actual data. The AI voice you're hearing. That's just my broadcast tool. Speed matters when things move this fast. So here's what I was looking at a few hours ago. Silver spot price hit $88.50. That's not a typo, $88.50. But here's the thing nobody's talking about. Gold was up 0.39%. Barely a blip. Platinum? Underperforming. Palladium? Dead in the water. This is not a precious metals rally. This is a silver-specific event. And the vertical move you're seeing on that chart isn't a rally in the traditional sense. That's the sound of a short squeeze, mixed with a physical bank run. And if this were just about Federal Reserve policy or some geopolitical fear trade, you'd see gold leading the charge. But gold is flat. Silver is up nearly 5% in a single session. That divergence tells you everything you need to know. This isn't about monetary policy. This is about physical metal, or more specifically, the lack of it. Because while everyone's focused on Jerome Powell and Donald Trump having their little power struggle in Washington, there's a vault in Shanghai that's screaming for silver bars. And they're willing to pay $10 per ounce more than the paper price in New York to get them. $10 per ounce. Think about that. Let me tell you exactly what I'm seeing, because this is the kind of intel that takes 12 hours to filter through the mainstream financial press. And by then, the trade's already moved another 5%. Here's my primary claim. Silver's break to all-time highs is being driven by an unprecedented physical inventory rollback. For the first time in history, the paper price in the West has completely lost control of the physical reality in the East. We are watching the death of the paper-silver scheme in real time, and I'm going to walk you through exactly why this is happening. I'll explain the backwardation trap that has the bullion banks cornered. I'll run the actual math on why the COMEX inventory is failing right now. And at the end, I'll share my personal 3-step battle plan for navigating the $90 to $100 transition that's coming. But before we look at any charts, you need to understand the numbers that the exchanges are actively trying to hide from you. So let's get into the on-the-ground reality. A few hours ago, I was looking at my screens, and here's what I saw. Silver spot in New York, $88.50. Shanghai silver, $98. The spread between those two prices is $10 per ounce. That means if you can physically deliver a silver bar in China right now, you can sell it for $10 more than what you'd get in New York. That's an 11% arbitrage opportunity. And in the world of precious metals, that kind of gap doesn't exist unless something is fundamentally broken. Now contrast this with gold. Gold's trading at $4,616, up slightly, but basically flat. Platinum and palladium are both underperforming, and this is not a broad flight to safety move. This is a silver-specific liquidity event, and here's where it gets interesting. On Monday alone, 850,000 ounces of silver were moved to the January contract for immediate physical delivery. That's not speculation. That's not paper trading. That's real metal being demanded by real counterparties who need it now. We're seeing what I call the great divorce. The paper price on the Globex platform, which is trading around $88, is being dragged higher by the physical price in the East, which is sitting at $98. And that $10 gap is acting like a vacuum, sucking every available physical bar out of London and New York vaults and shipping them to Shanghai. Now, stop for a second and look at the chart. I want you to really look at it. That vertical line you're seeing isn't a normal rally. That's not investor enthusiasm. That's not even a short squeeze in the traditional sense. That's panic. That's the sound of short sellers realizing they're trapped. And the physical metal they thought would be available to cover their positions in March doesn't exist. The shorts thought they could wait until March. They were wrong. Now, before we go any further, I need to explain a technical concept that's critical to understanding what's happening. It's called backwardation. And if you don't understand this, you won't understand why the banks are trapped. In a normal commodity market, you have something called contango. Contango means that the price for a commodity delivered in the future is higher than the price for immediate delivery. This makes sense, right? If you're storing grain or oil or silver, you have to pay for warehousing, insurance, all of that. So it costs more to get the commodity later because of those carrying costs. Backwardation is the opposite. Backwardation is when the price for immediate delivery, right now, today, is higher than the price for delivery 3 months from now. Let me give you an analogy. Imagine you walk into a car dealership and they tell you a car delivered to your driveway today costs $50,000. But if you sign a contract to receive the exact same car in 3 months, it only costs $45,000. Why would anyone pay that $5,000 premium to get the car today instead of waiting 3 months? Because they believe that in 3 months, there won't be any cars left, or the price will be even higher, or they need the car now and can't afford to wait. That's backwardation. It signals desperation. It signals a shortage. It signals that the people with the most information and the most money are willing to pay a massive premium to get their hands on the physical asset right now, because they don't trust that it will be available later. And that's exactly what's happening in the silver market right now. 355 silver contracts just rolled backward from March to January and February. Traders are paying massive rollover fees, losing money on the spread, just to skip the line and get their metal now instead of waiting 2 months. Think about that. These aren't retail investors. These are institutions, bullion banks, large funds, the so-called smart money. And they're willing to lose money on the trade just to ensure they get physical metal today instead of March. If the big money is willing to pay a premium to get silver today, what do they know about what's happening in February that we don't? Now let's talk about the math, because this is where the house of cards starts to collapse. Here's the arbitrage loop. If you can buy silver for $88.50 on the COMEX in New York and immediately sell it for $98 in Shanghai, you make an 11% profit instantly. No market risk, no directional bet, just pure arbitrage. Buy here, ship it there, collect the spread, and that's exactly what's happening. 1.77 million ounces were rolled back for immediate delivery in the last week. People are flying physical bars from west to east in a desperate attempt to close that $10 gap. But here's the problem. The drain is faster than the logistics. Every plane that lands in Shanghai carrying silver bars is immediately absorbed by demand. The premium doesn't shrink, it stays at $10. Sometimes it widens to $12. And that tells you that the demand in the east is so overwhelming that no amount of physical shipments can satisfy it right now. Now let's talk about the COMEX registered stocks, because this is where the system is breaking. The COMEX has 2 categories of silver. There's eligible silver, which is silver sitting in a vault that meets the quality standards but is not currently allocated to any specific contract. And then there's registered silver, which is silver that's been earmarked for delivery against open futures contracts. The registered stocks are facing a demand to supply ratio that is beyond anything I've seen in 12 years of tracking this market. The hidden math that nobody talks about is this. Every time the Shanghai premium stays above $8, it acts as a giant vacuum. Physical bars are being pulled out of New York and London faster than they can be replenished. And here's the scary part. The paper to physical ratio is collapsing. There are hundreds of paper claims for every physical ounce sitting in those vaults. As long as everyone's playing the paper game, buying and selling contracts without ever demanding delivery, the system works. But the moment a critical mass of traders says, I want my silver and I want it now, the whole thing falls apart. Because there isn't enough silver to go around. So let's recap where we are, because we're about 60% through this, and I want to make sure you understand the mechanics before we talk about what happens next. Silver is at $88.50. Shanghai is at $98. The market is in deep backwardation, meaning people are paying a premium to get their metal now instead of later. This isn't about the Federal Reserve. This isn't about Trump versus Powell. This is about a physical shortage that has the paper shorts trapped. And every day that the Shanghai premium stays above $8, the news tightens. Now, surely the banks have a way to stop this, right? They've been controlling the silver market for 50 years. They've got tools. They've got leverage. They've got the CME on their side. Let me address the skeptics, because I know what you're thinking. The skeptic argument goes like this. This is just a blow off top. The CME will raise margins, kill the leverage, and the price will crash back to $70, just like it always does. You're being dramatic. Here's my rebuttal. The CME did raise margins last week. It's a 47% increase. Massive hike. What happened? Silver laughed and went from $80 to $88. Margin hikes only work if the rally is driven by paper leverage. If a bunch of speculators are using 5-to-1 or 10-to-1 leverage to trade silver futures, then yes, a margin hike forces them to either put up more cash or liquidate their positions. The price crashes. But that's not what's happening here. People are buying for physical delivery. The 850,000 ounces that moved on Monday, those weren't speculators. Those were counterparties demanding actual metal. A margin hike doesn't stop them. It just makes the shorts even more desperate to exit, because now they have to post more collateral to maintain positions they know they can't cover. Let me bust another myth while we're at it. The common narrative is that the Fed controls the silver price, that somehow Jerome Powell and his team can just flip a switch and crush the silver rally whenever they want. In 2026, that's no longer true. The industrial demand from solar and AI has fundamentally changed the equation. Modern AI data centers consume 3 times more silver than old tech infrastructure. Solar panel production is at an all-time high. Electric vehicles use more silver per unit than internal combustion engines. The steering wheel has been taken away from the bankers and handed to the engineers. And the engineers need physical silver to build the infrastructure of the future. They can't use paper contracts. They can't use promises. They need bars. So if the banks can't stop it with margin hikes, what's their next move? Well, let me tell you what I'm watching for, because this is where things could get very messy very fast. The institutional reaction. Watch for something called force majeure or rule changes. If the COMEX cannot fulfill the delivery of those 355 contracts that rolled back into January and February, they may try to settle in cash instead of physical metal. That would be the ultimate betrayal of the futures market. You sign a contract that says you're buying silver for delivery, and instead they hand you dollars and say, sorry, we don't have the metal. Here's the cash equivalent. That's a default in everything but name. And if that happens, the credibility of the entire paper silver market collapses overnight. I'm also watching for a media blackout, or more accurately, a narrative shift. Expect the story to change from silver rally to silver hoarding, or speculation run amok. They'll try to distract from the industrial shortage by pointing fingers at retail investors or foreign buyers. They'll make it sound like the shortage is artificial, created by hoarders, instead of acknowledging that the industrial demand is real and the supply simply isn't there. Here's my dashboard. These are the 2 numbers I'm watching every single day. First, the $90 level on Globex. $90 is the final psychological door before triple digits. If we see a sustained break above 90 with volume and conviction, the algorithms start targeting 100. It becomes a self-fulfilling prophecy. Second, the Shanghai premium. If that premium hits $12, the vacuum becomes a hurricane. At $12, you're talking about a 15% arbitrage opportunity. Every vault in the West will be emptied. Every plane that can carry silver will be chartered. And the COMEX will have no choice but to either settle in cash or admit they can't fulfill delivery. Now look at the gold to silver ratio. A few hours ago, it was at 52 to 1. That means it takes 52 ounces of silver to buy 1 ounce of gold. Historically, that ratio has been anywhere from 60 to 1 all the way up to 90 to 1 during periods of silver weakness. But right now, silver is eating gold's lunch. That ratio is plunging, which means silver is outperforming gold on a relative basis by a massive margin. And that tells you this isn't a precious metals rally. This is a silver-specific supply crisis. The big 100 is no longer a meme. It's no longer a fantasy price target that silverbugs throw around on Reddit. It's a mathematical probability based on the current trajectory and the physical dynamics. So what am I doing about it? Let me share my personal battle plan, because I think this is where the rubber meets the road. First, let me be clear. I'm not your financial advisor. I'm a researcher. I'm a stacker. I'm someone who's been in this market for 12 years and has seen a lot of rallies come and go. What I'm about to tell you is what I'm doing with my own capital. You have to make your own decisions based on your own risk tolerance and situation. Here are my triggers. Trigger 1. If I see a 4-hour candle close above $90 with strong volume, I'm watching for the $100 magnet. Personally, I'm not selling a single ounce of my physical silver until the Shanghai premium normalizes. And by normalizes, I mean drops below $2. Right now it's at 10. Until that gap closes, I'm holding. Why? Because as long as that premium exists, the physical demand in the East is telling me that the rally has room to run. The moment that premium collapses, it signals that either supply is caught up or demand has been satisfied. Until then, I'm treating my physical stack as untouchable. Trigger 2. If the CME announces a double margin hike, meaning they raise margins twice in quick succession, I'm expecting a $5 to $8 flash crash. It won't last long, but it will be violent. If that happens and silver dips back to $82, I'm personally looking to increase my exposure to silver miners. Why miners? Because the mining stocks have not caught up to this move yet. Silver has gone from 70 to 88 in a matter of days, and the miners are still trading like silver is at 70. There's a lag, and when the market realizes that these companies are about to print money at $90 silver, the mining stocks will explode. But I'm waiting for the dip. I'm not chasing at all-time highs. I want the margin hike panic to give me an entry point. Trigger 3. The wait-and-see scenario. If the Shanghai premium drops below $5, I'm sitting on my hands. That would signal that the physical tightness is easing, that supply chains are catching up, or that demand in the East is cooling off. In that scenario, I'd expect silver to consolidate or even pull back as the arbitrage trade unwinds. But right now, the premium is at $10, and I'm not seeing any signs of it narrowing. So I'm watching the exit door very closely, but I'm not walking through it yet. Now let me talk about the psychological side of this, because I think it's important. If you've been stacking silver for years, you've probably been laughed at. You've probably had friends and family tell you that silver is a barbaric relic, that it's not a real investment, that you're wasting your money. You've watched the price get smashed over and over again, and you've wondered if you made the right call. This is your moment. But don't let emotion cloud your judgment. Don't get greedy. Don't start believing that silver is going to $1,000 by next month. Stay disciplined. Have a plan. Know your exit points. For me, I'm scaling out in tranches. If we hit 90, I'm considering selling a small percentage of my trading stack to lock in profits. Not my physical core holdings, but the portion I allocated for trading. If we hit 100, I'll sell another tranche. And I'll keep a core position no matter what, because I genuinely believe the long-term story for silver is intact. The industrial demand isn't going away. The supply deficit is real. The paper market is collapsing. These are structural trends that don't reverse overnight. But in the short term, anything can happen. We could see a flash crash. We could see a forced liquidation event. We could see the CME change the rules mid-game. And if you're over-leveraged or emotionally attached to every tick on the chart, you're going to make bad decisions. So stay calm, stay disciplined, and don't let the mainstream media narrative distract you from what's actually happening. Because here's the thing nobody's talking about. For 50 years, the bullion banks have controlled the silver price with paper contracts. They could print an infinite number of futures contracts, flood the market with paper supply, and suppress the price whenever it got too high. They've done it over and over again, but this time is different. And I don't say that lightly, because "this time is different" is the most dangerous phrase in investing. But the physical demand in the East has created a dynamic that the paper market can't control. You can't ship paper contracts to Shanghai. You can't build solar panels with futures. You can't use COMEX-registered silver to manufacture AI chips. You need the actual metal, and the actual metal is running out. The paper wall has been breached. The $10 premium in Shanghai is the crack in the dam, and every day it stays that wide, more water pours through. Eventually, the whole structure collapses. I've been waiting 12 years to see this. I've been tracking vault inventories, watching backwardation, analyzing the supply and demand fundamentals, and I've always believed this moment would come. The moment when physical reality reasserted itself over the paper illusion. And I think we're here. I think this is it. Now, could I be wrong? Absolutely. The banks could pull some trick I haven't thought of. The Chinese government could step in and shut down the arbitrage. The COMEX could announce a rule change that kills the rally overnight. Anything's possible. But based on the data I'm seeing, based on 12 years of experience, based on the mechanics of backwardation and the physical inventory drain, I think we're in the early innings of something much bigger than a normal silver rally. I think we're watching the death of the paper-silver scheme. And when that scheme finally collapses, the price discovery mechanism will shift entirely to the physical market. And in the physical market, there isn't enough silver to meet demand at $88. There probably isn't enough at $100. The real price is whatever clears the market. And right now, Shanghai is telling us that price is $98. And it's still not enough to satisfy demand because the premium isn't shrinking. So where do we go from here? I'll be watching the same numbers I mentioned earlier. $90 on Globex, the Shanghai Premium, the gold to silver ratio, the COMEX registered inventories. And I'll be tracking the narrative in the mainstream media to see if they finally wake up to what's happening or if they keep pushing the Fed story. But more importantly, I'll be sharing updates on this channel as things develop, because I built this specifically to give you real-time analysis, not the watered-down version you get 12 hours later on cable news. Things are moving fast. The mechanics of the great divorce between paper and physical silver are accelerating. And if you don't understand what's happening, the next $10 move is going to catch you completely off guard. So here's what I want you to do. After you finish watching this, go check out my deep dive on why silver miners are the next leg of this trade. Because when silver breaks 100, the mining stocks are going to explode, and you want to be positioned before that happens, not after. And if you found this valuable, if you want to stay ahead of the curve instead of reading about it in the Wall Street Journal 3 days later, subscribe to the channel. I'm putting out analysis like this every time something major moves, and right now, we're in one of the most significant commodity dislocations I've ever seen. The paper wall has been breached, the physical bars are doing the talking now, and the banks who spent 50 years controlling this market with paper tricks are cornered. This is not the Fed, this is not politics, this is supply and demand in its rawest form, and it's just getting started. I'll see you in the next one.